Welcome back. The global securities markets are shifting. At least the global primary equity markets are, to this part of the world. In the 90s, 80% of global IPOs were done in OECD countries. Now, that's down to 40%. In 2006, the value of emerging market IPOs was roughly equal to that of US-based IPOs. Now, US-based IPOs are down to half. This is but one big change facing securities regulators from across the world. The other is technology-driven innovation. So high-frequency trading, dark pools, and whatnot. Well, I spoke to Greg Metcalf, the chairman of the board of IOSCO, that's the International Organization of Securities Commissions, about the challenges facing regulators post the global financial crisis.
There's three key challenges we face as global regulators, and the challenges we face in terms of meeting what I consider to be our two key objectives, which is to make sure that investors can be confident and informed, right, and that markets are fair, orderly and transparent. They're our key objectives collectively as regulators around the world in financial markets. So first of all, I think what we see is structural change, basically market-based financing, which is what we oversee. There is a definite trend of that growing around the world, and there's a demand for it to grow. We're seeing with the banking regulation, the cost of banking is rising with higher capital charges and liquidity. We're also seeing that there is that constant shift of movement of savings from the banking sector into the pension fund sector as emerging markets start to develop retirement savings systems for their populations. But equally, we're seeing with demographic change, as more people move into that retirement phase in the developed world, and even in the emerging markets, more savings is moving into the pension fund system. And basically what they invest in is capital markets products a lot of the time. So that's the challenge, is that there is a need to harness those savings.
I think we've seen in the last 50 years that direct investments, especially in the developed world, have tapered off considerably. We've now seen it come down to between 10 and 25% if I was to broadly, band it. Are you saying that there could be a reversal of that and that we'll see direct investment in the market, that is investment not going through intermediaries such as mutual funds, in fact increase over the years to come?
I think that there's going to be a lot more focus on the efficiency of indirect or intermediate investment, which is the fees that you pay for that intermediate investment. And you're certainly seeing that evidenced by the growth of ETFs, in that they're purchased directly on the market as a product, but they still have the benefit of being managed, but they're actually very low fees. So I think you'll continue to see the growth of ETFs because of the low fees. But again, they're execution product in the market. Right. I think the other aspect I think you are going to probably see more direct investment is that investors are becoming more literate in terms of participating in markets. So you may have seen that trend over a long time, but I think that you may see a reversing of that trend. We're certainly seeing that in Australia, that the superannuation sector, a lot of it is moving more into self-managed funds from basically institutionally organised funds.
If this is an aging population saving, then does that mean this has a lower risk profile, and therefore how regulators look at the products that come to market to meet their investment requirements need to be regulated differently, let's say, from how they have been in the last 10 or 15 years?
Well, it's a good question. The self-managed super fund section in Australia is one which we consider to be of higher risk because they're managing their own money and they invest in capital markets products, and therefore that is quite a challenge. But the approach to regulating, if you want, the capital markets products is no different to what it has always been, is making sure that the conduct and the disclosure is appropriate. But one of the things I think that more and more we're focusing on is the limitation of disclosure as an effective way of communicating risk. And if you think about it, disclosure is just really a way of explaining the risks of a product. And one of the things that we're more and more focused on is behavioural economics, trying to understand how people make decisions and thinking about new tools that product manufacturers can use to communicate risk. And I think that is the new aspect of how we're thinking about how we regulate financial products, is to make sure that at the end of the day the investor understands what they're buying. Absolutely critical.
You bring up disclosure, and I know that we've, in the last 10 years, moved to a comprehensive disclosure regime, if I may say so, almost to the extreme, as some regulators today have pointed out, that we have 3-inch thick, sort of offer documents being filed, which most average retail investors would find very difficult to understand. Is this changing post the global financial crisis? Because people then had the disclosures but never really understood the product. So are regulators now looking at disclosures differently and saying it's not the volume of disclosure that you make, but its ability to be understood that's important?
Absolutely. So I think it's about two things. One, it's about multi-channel communication. So there are those that actually are very happy to read a 500-page prospectus and understand it. But there are those that, because of inadequacy of time or of lack of inclination to read through the document, they need information in a different form. And that's why, what we've been saying is to think about how we can use new tools like social media. If you think about it, the future is very much in terms of social media, in terms of mobile. It's about video. Think about how you can use those sort of tools to communicate the information to investors. The other aspect is that it is about layering of information. So there are some people who need the first layer, which is the key aspects of the deal, and there are those that actually want to go into that depth. So what's really important is to make sure that the way that if you are looking at a disclosure document, that it is layered appropriately, and that if you want the key fact statement is very clear, concise for those people who don't have the time. So I think there's a lot more thought got to be given to how information is communicated, and it's targeted to different audiences, and I think that's really important. And I think there is very much a view these days that it's not necessarily about the sort of a classical economic view that everyone's rational, but that people are human beings and we've got to think about how they behave. And I think that's clear. And to that end, at the next IOSCO board meeting, this is a topic that we're really going to focus on, on behavioural economics, and whether there are other ways in which we've got to think about how the disclosure of information is made.
It's been 5 years since the global financial crisis caused by CDO